Afternoon, everyone. My name's Scott Quinlan. Thank you very much for coming in today. For those that don't know me, I'm one of the financial advisors here at Solace Financial. Today we've got a couple of speakers. We've got Hick from Ausbil to give us an economic update, which will help us increase our wealth. And we've also got Rachel from Travel Associates today, which will inspire us to spend our wealth as well. So nice equilibrium. Inside of your packs there today, there's a feedback form. If you could take the time sometime during the presentation to fill that one in, you just leave it on your chairs. That'll help us make better presentations for you next time. Inside there as well is a little torch. It's my quality torch, that one. And also, my wife Bridie also works for Travel Associates. She's put a little travel book that she put together in there as well. So that's how the Travel Associates connection comes about. But firstly, I'd just like to give a quick explanation and talk about the update from Solace, just about what we've been doing. We've decided to go self-license. So this is just a really quick presentation just to give you an overview of what that means and what it will mean to you guys. So at the moment, ASIC controls the rules regarding financial planning, and inside of here are the rules that they, ASIC, make us do. So things like doing your statement of advice, giving you a financial services guide, those kinds of things. Financial Wisdom is currently a licensee or has a license from ASIC, and Solace Financial, we currently license through Financial Wisdom. There are lots of other financial planning companies under Financial Wisdom. They're all called different things, but they all have their license through Financial Wisdom. Financial Wisdom gives us things like access to IT and back-end office things and audits, things like that. Financial Wisdom is owned by the Commonwealth Bank, and they've been in the news a lot regarding financial planning. So we've decided to go self-license. So all this means is we still operate inside of the rules that ASIC provide. We might be able to in the future provide more services to you, just depending on what you need. So it's really driven by you guys. And we simply have another company called Solace Financial Dealer Services, SFDS is what its company's called. So if you see that on things in the future, that's what that is. And we're just licensed under that. So same for financial advisors, same process that you guys are used to, same reviews, same investments, no change in that. We're not going to change any of our fees, and pretty much the same experience for all of you guys. So, all right, I'll hand it over to Hick, economic update. Thanks.
Good afternoon, everybody. It's a pleasure to be here. Thanks for the invite, Scott, and the rest of the team. So I'm going to give you I work for Ausbil Investment Management. I've known the guys for many, many years now. I've been at Ausbil, I'm into my 12th year now at Ausbil. Ausbil, we're an Australian equity fund manager predominantly now. We actually have started to offer investments overseas as well, but basically for 21 years we've invested into Australian shares on behalf of our clients. So we started back in 1997. So I'm going to give you an economic and market update, but the first thing I always have to show is the legal side of things. So I believe you've got the slides in your pack, so if you want to read the disclaimer in full, by all means go ahead. But I'm going to give you my précis version, which is just that I am a representative of Ausbil, providing information, not advice. You have 4 wonderful advisors and their support staff at Solace, and those are the people you seek for advice, not me. So please don't act on anything I say here without discussing it with your financial advisor. So without further ado, Stephen was talking to me earlier and said, oh, your slides are nice and updated, and it's because last night I decided I'd add a few slides in to really address what's happening right now. So we've had the markets on the slide in the last month or so, and so I got your sort of Google images and got a picture of a distressed trader. It's not that distressed actually, and that's probably about right, because this is not the global financial crisis what we're experiencing right now. It's more a bit of a correction after a very strong run for global equity markets. So yeah, I found one where there wasn't too much distress, a little bit of confusion perhaps, but not too much distress. So let's put the whole thing in context though. So first of all, I've got a chart here, and obviously if you can't make out what the dates are, you've got the slides, but I'm going to describe what I'm showing you here. Two charts rather of the Dow Jones, which is one of the main US equity market indexes. And the first chart is showing the progress of the Dow Jones Industrial Average, the top 30 US companies, over the last year. And the bottom chart is showing the progress over the last 10 years. And so the first thing I'll highlight is, this is what we're experiencing right now, which is what is termed now as a technical correction, because from the peak of the Dow, which was in October the 1st, the US market has fallen by more than 10%. That is technically a correction. It's not a bear market. A bear market is when markets fall by 20% or more. So the global financial crisis was the last proper bear market markets experience, which was a long time ago now, actually. A decade ago we were in the last bear market. But that's a significant sell-off. But take it in the context of what we've seen before. So for the last 12 months, the Dow Jones is still up. So it's up about 6 or 7% from this period right up to yesterday evening. So that's still a reasonably positive outcome, and certainly it's still positive when you take it into context of the last 10 years. So the low of the market in the GFC, I haven't shown the big fall because I've got a chart of the last 10 years, and the GFC began in 2007, and the collapse of Lehman Brothers is now more than 10 years ago. But if you went back here, the markets would have been falling, but the low point was March 2009. And at that point, the Dow Jones was around 6,500. It peaked out in October of this year at 27,000 thereabouts. So that's a more than fourfold increase in price alone over a decade. So a very strong performance over the last 10 years. And part of that has been driven by a lot of stimulus, both monetary policy, interest rates, and also more lately fiscal policy. So since the Trump administration came in, there's been tax cuts and other things, which have meant the US economy has been quite strong. And most importantly, US companies have grown their earnings quite a lot. Interestingly, this year, when we've only now had a 7% in the last 12 months return, US corporates have grown their profits by well in excess of 10%. So actually, if you look at it on the price earnings ratio, which is a measure of the value of the market, the US market has got cheaper this year because prices haven't gone up that much, whereas earnings have gone up quite a bit. So actually, the US market is cheaper now than it was 12 months ago. But I just wanted to give you that context of the whole 10-year. I can show you the same chart for Australia. It doesn't look quite as good, unfortunately. It's still positive. It may not be positive on a 12-month basis in terms of price. So I've shown the ASX 200, which is our top 200 companies. And again, we've had a fall of roughly 11% from our peak, which was again back a month and a half ago. And from 12 months, exactly 12 months ago to yesterday evening, our market had actually fallen about 2% in total. But this is price only. The Australian equity market is one of the best income generating equity markets in the world. So you're actually, when you include your dividend income and your franking credits, the overall return, if I was to show you a chart of what's called the accumulation index, even for the last 12 months, is still positive at around 3%. And certainly, again, if you look at the 10-year chart, again, the steepness of the gradient isn't as steep as the US market, but from that March 2009 low, our market on a price alone basis has doubled from around 3,000 up to over 6,000. It's come back a little bit in the last month, but when you include dividend income, which roughly, including franking credits, is averaging around 5.5% per annum, you actually get a total return over the last 10 years, annualised, in Australian equities, if you're just invested in a passive investment into Australian equities, of almost 8%, 7.7% per annum. And of course, if you're invested in one of our wonderful products, you're going to get a better return because we've managed to beat the market consistently over that time period. So that's my little plug there. So for Osborne, I'm keeping it non-product, but I've just had to say that. So the overall context is still supportive, I would say, for equities. It's our view at Osborne that this is not a turn into this is not going to turn into a bear market, because we're still relatively positive on economic growth and earnings, and that is fundamentally what should drive equity markets. Stephen also mentioned I should have shown the Aussie market for 20 years, because if you actually look at the 20-year return of Aussie equities, it actually outstrips the 20-year return of US equities. So maybe I should have gone back a little bit more. But I thought what I really wanted to show is from the depths of the GFC to where we are today has been a pretty good run for equities. So now I'm going to talk about economics and what's caused this market sell-off. You know, some headlines, I'll touch on all of them. IMF have downgraded their growth expectations. They're forecasting a slowdown in growth. That was the headline a couple of weeks ago. So the International Monetary Fund is always predicting through their economics department where growth is going, and they've taken a couple of points off growth. So they're forecasting growth next year to be 3.7% instead of 3.9%. But let's give it some context. So what I've got here is a rather busy table, but I'll lead you through it. So this is showing a number of things. The headline, that consensus number for 2019 has dropped to 3.7% growth. The expectation for this year is the global economy is going to grow at around 3.8%. I'd say that's neither here nor there. That still looks like a pretty healthy growth number. 3.8% this year, 3.7% this year, next year. So we're not talking about recessionary conditions. We're talking about them trimming their expectations, saying overall the global economy may grow slightly less next year than this year, but it's still growing very healthily when I compare it to the averages. So since the global financial crisis, this column here shows the average growth rate across various economies and in aggregate. So looking at that total number that I referred to from the IMF, where they're saying 3.7% for next year, compare that to the average over the last 10 years, 3.3%. So we're growing above average. That's not a bad outcome for 2019. If I look at particular economies, the US economy, the IMF expects to slow down a little bit to 2.2%. Oh, sorry, let's go. That's the advanced economies in total. Let's look at the US. 2.6% they're expecting for next year, which is a drop from 2.9% this year. We're more optimistic. The blue columns are Osborne. We actually think the US will grow at around 3% this year, and again around 3% next year. Maybe slightly less next year than this year, but certainly we're more optimistic than the overall consensus is. But again, I point you to the post-crisis average for the US economy is only 1.3%. So the US economy is going at twice its average run rate for the last 10 years. And there are other measures we can compare to as well. The so-called potential GDP. This is the rate of growth that economies, if they're running at full capacity, are expected to deliver. And the US, because it's a mature economy with an aging population, without generating inflation, the economists reckon the US can grow at around 1.8%. So the US is growing at better than it actually can sustain in the long run, and we expect that to continue given all the tax cuts and increase in spending that's happened in the Trump administration. So we're quite positive, at least in the short to medium term, on economic growth, not only in the US. If I look at other parts of the global economy, I'll touch on Europe, for example, where the IMF is forecasting a growth rate of around 2.1% for this year, and next year a slowdown to 1.8%. But that slowdown, take that in context of the last 10 years where there's been hardly any growth, 0.4%, and again, 1.8% is actually better than their estimated long-run potential growth rate. So Europe's had a really tough decade, but it is actually growing at above trend and will continue to do so, even in the view of the IMF. China's the interesting one, especially for Australia. So this is where it gets interesting. So we know that over 30 years, China's average growth rate has been about 10%. That growth rate is undoubtedly slowing down as the economy matures. The expectation is around 6.5% for this year. That's a slowdown on the last 10 years, where it's averaged about 8.4%. But again, it's above its potential because China is maturing. The potential forecast is around 5.8. there's some bearish forecasts that are saying China's going to actually grow at a much slower rate, especially given all this talk about tariffs, which I'll touch on in a minute. But our view is that Osborne, no, China will continue to tick around 6.5% this year and next year. And again, that's supportive for Australia. We sell a lot of things to China, especially raw materials. So overall, what I'm trying to get here is the picture isn't bad. There is an incremental, small slowdown potentially in certain parts of the global economy, but it's still better than the long-term average. So this isn't a doom and gloom situation by any stretch of the imagination. So trade wars is one of the big concerns that everyone's talking about. Trump's introduced tariffs against the Chinese, and surely this is going to cause the global economy to not just drop a little bit. Isn't it going to cause catastrophe? So our view is no. Our view is that actually it may not be the way we would do things, but certainly we think this is part of a broader renegotiation of trade. It's not necessarily ongoing long-term trade war. So what's interesting though is let's look at how the US trades and who the US trades with. So this table here shows trade, imports and exports to and from the US from various localities. What you'll see straight away is China is not that important to the US. In the great scheme of things, it's Mexico and Canada and even the European Union, and this is highly industrialized emerging Asia. So there's all sorts of other parts of the world which are more important for the US in terms of net trade. These dots here is the trade balance. It's basically when you take exports away from imports, and the US is in trade deficits with most of these major trading blocks. Interestingly, Australia, which is obviously tiny for the US in comparison to Mexico and Canada, we actually have they have a trade surplus. So we buy more from the US than we export to the US. So Malcolm Turnbull, before he left, when he first met Trump, did suggest that Australia may not be one of the villains, because Trump doesn't like this. Trump doesn't like these negative trade balances. But what's important though is China is not going to, poor trade situation with China isn't necessarily going to derail US economic growth. And more importantly, Mexico and Canada, they have renegotiated. So this is where our thesis that this is really negotiation, not maybe the way we would do it, but it is negotiation rather than an ever-increasing trade war. Because Mexico and Canada have come to a new agreement. They've renegotiated the North American Free Trade Agreement, NAFTA, into a new agreement between Mexico, Canada, and the United States, which Trump sees as more favourable. So we would put it out there that the Euro area is already negotiating with the Americans, and even though there's a lot of tension and a lot of rhetoric and some tariffs going on, we still think there will come a negotiated deal with China as well. So we think that there's a lot of noise around trade wars. It's clearly not good, but we think it's overblown. That's our view. And we point to this as well. We've experienced decades of ever better free trade. And this shows the share of total import, the effective tariff rate on imports in the United States over the last 100-odd years. And what you'll see is over time, there was a blip during the war, the Second World War, but over time tariff rates have come down to an exceptionally low rate where we're essentially getting free trade on the majority of imports into the United States. And what's happened recently is there's been a small increase, and if the proposed China tariffs come in, you can't see it very well, you might see it in your pack. If the proposed extra tariffs come in, it will have a raising effect, but it will bring us back to the sort of where we were in the 1970s. That's not good, but you have to take it in overall context. This is not economic Armageddon in our view. It's not good, but it's not economic Armageddon. And China's responding, most importantly. China isn't going to let its economy fall over if it starts to have these tariffs impact its exports to the United States and other countries. So they're doing stimulus. And this is the important bit. I've got a lot of busy information on here. You can read it at your own leisure on your slides. But what I really want to focus on is that the stimulus they're going through, tax cuts, increased spending, loosening of credit, the stimulus that they're having in 2019, both monetary and fiscal, is equivalent to almost $6 trillion US, which is 4 times the size of the Australian economy. So the Chinese are going to stimulate their own economy next year by 4 times the overall size of the Australian economy, and it dwarfs the stimulus that they put in during the global financial crisis. There is no way that the Chinese economy is going to go into recession, not in the next couple of years, and that's undoubtedly good for Australia, because if the Chinese did go into recession, it would not be pretty for Australia. Part of the reason we've had an economic miracle over the last couple of decades, as some politicians like to tell us, is because of the strength and growth of China. So what is the biggest concern? Actually, stripping away trade, tariffs and IMF downgrades, it's really about interest rates. This is what interest rates is always what derails equity markets. And bull markets end when interest rates go up. And one thing that is happening at the moment is interest rates are going up in the United States. So I've got a few charts on a page. It's a bit messy, but I'll explain what this is. So what we've got here, first of all, on the right-hand side is the US cash rate, the equivalent of our cash rate. This is the red line, and it's superimposed over what's happening in Europe and Japan, and post-global financial crisis, where rates were cut dramatically because of the global financial crisis and the need to stimulate economies. And we had a long period in the United States of 8+ years of ultra low interest rates, and over the last couple of years, very gradually, the US Federal Reserve, the equivalent of the RBA, has started to tick up interest rates. But interest rates right now are at 2.25% after 2 years of rises. They're still below where they were pre-crisis. Okay, so interest rates are starting to normalise. Typically, interest rates don't really start to affect stock markets until they are above normal, so they've become restrictive. So it's our view at Ausbil that at this sort of level, it's not enough to derail an equity market, because it's not enough to cramp US economic growth. And as long as economic growth is okay and the cost of borrowing isn't too high, US corporates still will be able to generate profit growth, and that's the really important thing. I've also shown a similar chart, but not looking at short-term cash rates, but rather 10-year government bonds. The red line is the US 10-year Treasury, aqua line is the German Bund, 10-year Bund, and the other line, the gold line, is the Japanese JGB, government bonds, 10 years. And what's interesting is, of course, government bond rates react to short-term interest rates. So US 10-year bonds, and these type of numbers, the yield on these instruments is what drives the cost of servicing debt, and also how you value equities. These rates on US bonds have risen from about 1.5% a year and a half ago, 2 years ago, up to around 3.1% today. Again, compared to pre-GFC levels, where they're around 4 and 5%, still relatively low. The concern is, are they going to continue to go up? This is the real concern. Are these going to continue to go up? And at what point does it really start to hurt economic growth? Our view is rates will only increase very gradually, because still there isn't much inflation. The chart below here shows the core rate of inflation in the United States over time. This period here is the global financial crisis. Inflation has been generally trending down since the global financial crisis in the United States. It started to go up more recently as the US job market tightens. So actually unemployment, the headline rate at least in the United States, is as low as it's been for 40 odd years at 3.9%. So there is some wage growth coming in through now, but inflation is only around 2% in the United States. So that's comfortably within the Fed's target. So we don't believe the US Fed is going to raise rates aggressively. Inflation is under control. Therefore, there will be only a continual, gradual normalisation of interest rates. So from our point of view, all of this means that the US equity market can track on okay. At some stage, as rates go higher, it will start to affect valuations on equities, but we don't think we're quite there yet. And in Australia, it's very interesting. Our cash rate looks a little different in that it's still at record low levels. We actually had post-GFC the situation where they slashed interest rates, short-term interest rates, and then put them back up because we had a mining boom. So we went down, up, and then since the mining boom tailed off, interest rates have gone down, and we've stayed at 1.5% for a very long period by historical context. You can see that generally interest rates move around a lot more, and it means that Australian government bonds historically at an extremely low level of around 2.65%. What's very interesting for me is the Australian government bonds, 10-year bonds, are lower than the US. And that is, in a historical context, is very unusual, and that's part of the reason there's pressure on the Australian dollar, because generally Australia has a higher interest rate than the United States. So from my perspective, I believe that the US dollar is going to continue to be strong versus the Aussie dollar. That might be relevant for the next discussion about travel, and so your overseas holiday, I don't think is going to get any cheaper in the next year or two. So, but again, that's just my view. It's not advice. It's not saying go and fix your currency now or anything like that. But this is an interesting situation. We don't see this very often. But clearly, from an Australian equities perspective, low interest rates is supportive of the Aussie equity market, because we're comparing an investment in Aussie equities to the risk-free rate of return, which is investing in government bonds. So this makes the Aussie equity stack up quite well. My summary is that the US economy is still very, very strong. Europe is consolidating after a very slow 10 years. The Chinese economy is slow, but stimulus is coming. Trade wars are a concern, but we believe trade deals are being done. There are, of course, other risks that I haven't even mentioned, like the Brexit uncertainty, the Italians kicking up a fuss in the euro area, all sorts of other things can affect markets, but generally we're still glass is half full. Cash rates, bond yields to go higher, but only slowly. Market volatility will be higher and has been higher this year than last year. That is normal because we're in the latter stages of a bull market, but we're not at the end in our view. So that's my summary.
Thank you. Please welcome Rachel from Travel Associates.
Now we're just going to have a little chat about a few different destinations for you for holidays, and then we're covering every sort of holiday, from your luxury holidays to your more budget conscious, so you can get more bang for your buck on your holiday along the way. So we're going to discuss Scandinavia, Japan and Croatia today. So they are three really beautiful destinations, very popular at the moment, but also you can do these on a budget, or you can do them go all the way within this funnel. Now we were just discussing the airfares and holidays before. He was just mentioning about this being more expensive. Honestly, it's the cheapest it's been in about 30 years at the moment to travel. So I've been travelling backwards and forwards to Europe for coming up 30 years. And I paid up to $2,500 for airfares 30 years ago. I'm now paying $1,400. So the airfare market has changed dramatically, and more people are having the opportunity then to travel business class and all of those things as well. So Scandinavia. So I am going to read a little bit from here, if you don't mind. So if I do look down and I'm not making eye contact, if you've got any questions, please pipe in. So Scandinavia is a truly astonishing part of the world, home of the Vikings, the Midnight Sun and the Little Mermaid. Scandinavia offers a wonderful blend of history, modern culture and natural beauty. Marvel at the Scandinavian's breathtaking scenery, mountains, rivers, fjords, and taking in the chic coffee shops in Copenhagen. It really does have something for everybody. Best weather obviously is summer months, so June through to September, with understated elegance. So Viking Cruises is your luxury trip. So you are looking at up to $600 per person per day. So a cruise could be up to $18,000 for a cabin. Just know that includes everything you need to worry about. There's not an extra thing you have to concern yourself with. Complimentary meals, all your shore excursions, on board amenities, beer and wine at all your meals, premium dining service, unlimited Wi-Fi, self-service cleaning, laundry, and also thermal suites in the rooms as well, plus 24-hour room service. So it is absolutely gorgeous. So this is one we're talking about, which is approximately $600 per night, but it does take in everything, and you're even getting into Russia on that itinerary. So it's a beautiful itinerary if you are thinking about heading up to that part of the world. And when you do look at the overall cost, I will say that yes, you can see your Princess product, which is absolutely gorgeous as well, and a lot of other products, but then there's all the extras that you have to then pay for each excursion along the way, each drink on board, everything else along the way. Well, this is just literally you get on that ship and there's not a thing you have to worry about again, other than bringing back your travel agent and present. Okay, so I ask for them all the time. It doesn't happen often enough. So probably the best present would be for them to they come back and tell me all about it, which is always the highlight for me.
Does it include gratuities?
Yes, includes your gratuities as well, and butler service and a lot of other extras as well. So that's all, yeah, so it is a beautiful product, and I do have a brochure if anybody wants to have a look at it today while we're here. So if you are then thinking, I really want to do this part of the world, but I don't want to do it at that sort of cost, we've got our Cosmos. Now this one comes in about $185 per person per day. And this is a land, obviously mainly a land product, but you also have some of the ferries in between. And Cosmos is a remarkable product. I have been selling this now for 7 years to my clients, and I've never had a client come back and say a negative thing about it. So this does have more freedom. So every day they will include some sort of tour in the morning, but then the rest of the day is up to you what you do. So you can choose to partake in another tour that they're offering, or you can go and just wander around the street yourself, find a nice coffee shop, soak up the sun and the atmosphere. Really is a choice thing, but an absolutely gorgeous product. And the great thing about Cosmos also is that you do know upfront what your extra costs are going to be. So if you are thinking, I want to do some of the extra excursions, you will know what they are through their online system up to 3 months before the trip. So you'll be able to have a look at those as well. And they include breakfast daily and lovely 3.5 star properties all the way through as well. So moving on to Japan. So this is another kettle fish altogether. This is one of those places, it's not a one-trick pony. It's a very modern metropolis, but also very, very steeped in history as well. So there is everything there for you. Any experience you want, you can have there. So there's remote regions and UNESCO World Heritage listed thatch houses or untouched alpine towns along the way. No matter where you go, you'll be blown away by Japan. It is quite remarkable. I've had a number of clients there recently and been following them on Facebook and just blown away about the different experiences each and every one of them have had along the way, or doing a little bit more independent or being with a group tour along throughout the time. So obviously we all know the cherry blossoms. Now that's obviously in their spring season, your April, May period of time, you'll get the cherry blossoms. But Japan at any time of year is a spectacular visit. So you have Abercrombie and Kent, a beautiful luxury itinerary. So which is something that they have anything from $16,775 per person. But this is all using the speed rail along the way and taking in every bit of Japan that you'd like to encompass along the way as well. On the journey, marvel at some of the country's most impressive gardens and glimpse the magnificent mountains. You'll also get the experience of going and seeing a wrestling bout with the sumos, which would be a very interesting experience, and find a spot in a classic onsen and rest up in a traditional ryokan as well as part of that. So some of the luxury bonus you can expect from Abercrombie and Kent, because it is a small group touring, is you have a travelling bellboy. Simply leave your bags, pack bags at the door, and you'll find them at the next destination. A complimentary laundry service at the midpoint of the journey, which is always a nice little extra. Trying to find a laundromat somewhere nearby is always a fun thing as you're going along on your journeys. And you also do have the option of breakfast in bed twice along the journey as well. So it's a really lovely option. If you're thinking more of a family or more budget style, we have our Club Med. So luxury for less. Has anybody ever stayed in a Club Med property before? No? Yeah, but there's a nod at the back of the room with one of the girls. So does anybody know a lot about Club Med? No? Well, Club Med is a French-based company, but they do fully inclusive resorts. So that's breakfast, lunch, dinner, all drinks are included in the cost. And if you are looking at a ski holiday up in Japan, they will also include some ski lessons, lift hire, and also their gear. Ski gear. What's ski gear? Snow gear? Ski gear? Snow gear. When people say, do you like skiing? I'm like, no. So that's always my response to that. But they do have 3 different properties over there. So you have located in the coral reef on Okinawa, I can't say that, to the snow-capped fields in Hokkaido. So they are fantastic if you are thinking of a family holiday, because they have facilities for children. They have kids clubs that will look after your kids for the whole day, and they are amazing, amazing holidays. So if you're thinking about a family journey with your grandkids or other family members, it is a lovely, lovely option to take you up to Japan. Because people always assume Japan is quite a good value destination, it can be very pricey. So when you're looking at an 8-day stay for $3,300 with all meals and everything included, that's very, very, very good value. So Croatia. So how many of you have been to Croatia? Well, a few hands are going up. So what did you think of it? Loved it? I loved it. That's what I love to hear. So we really have, with Croatia, we have a lot of different ways of doing it as well. So Croatia has become the most popular tourist destination over in Europe at the moment. Very good value still, and the mere mention of Croatia conjures up images of pristine landscapes, sparkling seas, fortitude towns, furnished and outdoor cafes, heaving, carefree yachties. It in fact has some of the greatest empires have been there. So your Roman, your Venetian, your Ottoman Turks, and Habsburgs have all left their calling card on to form Croatia. Very, very interesting history in that country as well, and it's a very, it's just beautiful. But there's something else that is very, very famous for now. So Dubrovnik, what do we know as? Is anybody a fan of Game of Thrones? Yeah, Game of Thrones. Anybody else here watch Game of Thrones? Yeah, a few of you. So Dubrovnik is the place to be for the Game of Thrones experiences. So, so many a photo I've seen from friends and family and colleagues this year have been the walk of shame along the steps. So it's it's up to the coast of Kokulia, and a mini fortress is another area that rivals Dubrovnik. UNESCO protected cities of Splits is a town within that town, and a maze of cobbled alleys. So it's another beautiful one to see. So what we're looking at here in this picture, we are actually looking at the Region 7 Seas. And again, it's that 5-star luxury option of doing Croatia. So in this, you've obviously also got a lot more. You've got Venice, Zadar, Kotor, Corfu, all the way through to Barcelona. So it's a beautiful itinerary, and again, very, very good value for an all-inclusive option if that is what you're looking for. We also then have our Perico and small ship cruising option. So this is where you get to go into those more unique islands and those more unique towns along the way, and really get to experience the Croatia that people see in the pictures and everything like that, while you stay in the luxury yacht the whole time. And again, the value for that for 8 days of $3,300 per person is really good, a great value along the way as well. Now that is just two of the options of each of those destinations. There are so many other ways of doing these countries and seeing all of these beautiful places. And it's just knowing what you want. And as a member of the Travel Associates family, we tailor it to you. We're not looking to put you on the 6-star luxury. If you're thinking we want to see 3 things in the same price, we want to take some other people with us, we can tailor it exactly to what you need along the way and make sure your holiday experience is what you're looking for. And if I feel that it's not the right fit for you, I will tell you, and I'll say I feel that I think that you'd like this option better, because that's what we're here to do, and make sure that your holiday, or your dream holiday, is perfect all the way along. Well, thank you so much. It's been absolutely lovely meeting you today, and I hope that you've enjoyed that little presentation. I have got some of the brochures here if anybody has got any inquiries, and I have my business card if you'd like to have a chat. So thank you so much for inviting me along today. It's been an absolute pleasure, and I'd love to help you spend some of your lovely retirement money.
Does anyone have any questions for myself, Rachel, or Hick?
Do you see interest rates going up in the near future?
Hick, do you see the interest rates going up in the near future for Australia?
Our view is that they won't move for until middle of next year at the earliest. And we still think there's likely to be a rise, but there's definitely views out there that it might, the next rate rise might be, the rate movement might be down still in Australia, but we're not of that view, because our view is economically things are actually still good. You'd only have that view if you thought that what's happening now is the precursor to a significant economic downturn. But that's not our view. So we think the next move is up, but not imminent. Yeah.
The American interest rates were the big issue going up. If they go up still, we know they're going to go up. If they go up steadily or an expected rate, do things still bubble along okay? Or is it really if they just shoot under?
Well, the risk is more rapid. So the Federal Reserve is not going to raise rates rapidly, but it's more about that 10-year government bond, because that's market dependent. That's not, of course, the 10-year bond yield reflects the Federal Reserve's Fed funds rate, but you can have moments where the 10-year bond might start to spike in terms of yield, i.e. the price is falling, and that would be driven by concern about the inflation. But our view is actually there's an anchor on 10-year bonds in America, and that's the fact that in Europe and Japan rates aren't going up. So actually that chart I showed showing the US 10-year bond going up to around 3.1%. Japanese bonds currently, the 10-year bond is about 0.1%, and the German Bund is 0.4%. So they're an actual anchor on the US, because on a relative basis, every time the US yield goes up, some of those money flows from those Japanese and German Bunds and other bonds into the US market. And when money goes into US bonds, the rates come back down, because bond prices are inversely related to yields. So the higher the US bond yield goes, the more flows go in if interest rates everywhere else are still low. So you start to worry more about equity markets when other central banks start to raise interest rates. That hasn't happened yet. We don't see that happening in the short term.
Well, if that's it, thank you very much for coming in. Don't forget to fill in your feedback forms, just to help us put on better seminars for you in the future. And there's still lots and lots of sandwiches and tea and coffee. Thanks, guys.